Hello everyone! As we do each quarter, we're going to share with you the main insights that can be extracted from our digital top-down methodology. Our methodology consists of assessing the attractiveness of European equities based on 4 complementary pillars of analysis. The first pillar deals with the economic growth momentum in Europe. The latter has recovered strongly since the end of September due to sentiment indicators that are recovering from historical lows in some cases. The recent fall in inflation and the reopening of China are contributing to the gradual improvement in confidence. At the same time, economists have put an end to almost a year of downward revisions of the economic growth outlook in the euro area. The expected GDP growth in 2023 is 0.5% against minus 0.1% expected at the beginning of the year. The second pillar relates to the monetary policy implemented by the ECB. As expected, the rate hike was quick and intense, but perhaps a bit too much for a still fragile banking sector. The sector's setbacks in March, with the collapse of Silicon Valley Bank and then the controversial takeover of Credit Suisse by UBS, had the merit of making central banks realize what the red line is in raising rates. The market was not mistaken. Expectations of rate hikes have been revised downwards very sharply, especially as inflation is expected to continue easing in the coming month, and this is reflected in a positive drop in long-term yields. And this has consequences for the third pillar of our analysis, which is valuation. At the end of February, the European equity market risk premium had reached its historical average for the first time since 2008, fully justifying from a fundamental point of view the correction observed in March in the indices. The good news is that the sharp drop in long-term yields, coupled with the more moderate drop in indices in March, has allowed the risk premium to be rebuilt, and it now stands at 5.3%. Finally, the fourth pillar deals with the behavioral aspect. The European indices are in an uptrend, as they've been moving above their 200-day moving average since October. Moreover, the successful test of the 200-day moving average during the correction in March further strengthens the trend. In conclusion, the rise since the end of September has cleared up the undervaluation of the indices, as well as the excessive pessimism that we had strongly highlighted. In this context, it would not be surprising to see less directional markets in the coming month, but also more selective and inclined to stock picking, as a period of quarterly publications is about to begin. Thank you, and see you next quarter for a new video by Shaheen Capital.